Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Phil Mackintosh, chief economist at Nasdaq. We're going to take a look at jobs data, inflation and interest rates, and of course, those rising prices. Phil, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me again, Jill.
All right, Phil, let's start off with a review of what we're seeing in the market in general. Certainly the jobs report was somewhat of a catalyst last week.
Yeah, I mean, in reality, the stock market's kind of been going sideways, but with quite a lot of volatility, hasn't it? And when you look at what really stirred things up, I guess, in the last 5 days, it was the jobs number, which came out last Friday. And the expectation was that jobs would be really quite weak because of Omicron, because people had taken time off work because they were sick, because businesses were being shut down, the bookings in the restaurants and the airlines looked like they were down. And the surprise was a massively strong number with close to 500,000 net jobs created. So it gave us all a lot to think about. And the economy seems a bit stronger than we thought based on early January data.
All right. If we go and take a look at Fed rates, of course, we know March 13th, I believe the date is when we'll get the decision on rate hikes. 25 basis points seems to be locked in. Perhaps we're even looking at 50 basis points.
Yeah, there's definitely some people starting to ratchet up their expectations right now. So the running theory is that we'll have 3 or 4 rate hikes of 25 basis points at a time, spaced out over the year. But a lot of people are now saying, hey, maybe we could get nearly 7 rate hikes. Maybe the Fed will start with a 50 basis point rate hike. And if you look at the actual rates on some of the short-term bonds, the market's actually sort of 50-50 on whether we're going to have a 25 or a 50 basis point hike in March.
And if we go back to jobs for a moment here, I guess the key question is, where are the employees? And I thought some of the data and some of the things you tried to extrapolate from it were pretty interesting, particularly when people are identifying as entrepreneurs these days.
Yeah, I mean, you look at the participation rate, and there is 3 or 4 million people that still have not come back into the workforce. So even though the unemployment rate is really low, it was 3.9%. It actually ticked up to 4% because some people did come back into the workforce, but we're still short sort of 3 or 4 million workers. There's about 1 million that seem to have become entrepreneurs. And that's what you're talking about. Like, are they really entrepreneurs? Are they starting new businesses and hiring people, or are they gig economy workers? And it's hard to tell right now. If you look at some of the surveys, there's still a lot of people that are nervous about COVID, nervous about the health consequences, or just looking after kids. And we know there's a huge amount of retirees that probably accelerated retirement because of COVID too. So even though things look tight, it's partly because the people haven't come back into the workforce. So there's not enough workers.
And that's such a great point that you make about the entrepreneurship identification, because could you imagine if they truly were 1 million entrepreneurs and all those jobs that could be created? I mean, that's a total game changer there in and of itself. Let's wrap up here and talk about what you're seeing in terms of prices.
Yeah, so obviously I guess the problem for the market when you see such strong job numbers is the economy is still pretty hot, which might mean that the pressures on wages go up, which means companies have higher costs, which they pass through in prices, which means inflation isn't going to come down in the short term. It might persist for a little bit longer. If we look at the inflation month on month, we actually can see that the most recent inflation data is already well below where it was 6 months ago. So the spike in inflation has kind of passed if you're looking at monthly data, and it's expected to continue that way. Really, the reason we've got inflation is because food's expensive because people have got COVID and they can't come to work. Energy is expensive because oil prices are going up. And energy in theory should come down once we normalize the production cycle a little bit too.
All right, Phil, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.